Good morning from our global headquarters in New York. I'm Analyst. Welcome to Bloomberg Brief. Let's set your agenda. Risk on unleashed as cooler U.S. inflation reinforces Fed rate cuts as soon as September. Big money bets. Buffett's Berkshire reveals his stake in the insurer Chubb. Michael Burry doubles down on China tech. And we get a fresh read on the consumer and the global economy when Walmart and Deere report their results before the bell. More on the U.S. consumer in just a few hours. But this is about a roaring risk rally right the way across the risk spectrum, so much so that you've got BMO talking about stocks hitting 5,600. Just a couple of months ago, they were talking 5,100. BMO ups the game to 5,600. We are underassuming the level of growth out there. Some other lovely reveals in the 13. Where Warren goes, we all follow Chubb. Up almost at the moment, let's just see, up nearly 9.5%. As we understand, Berkshire Hathaway has a position in that. And then at the same time, Michael Burry talks about what he's doing with JD.com and Alibaba. But Cisco upping the guidance. So Cisco nicely bid this morning as well. Bottom of your screen, up 4.5%. Now, bang for your CPI buck. On a hot print on CPI, the bond market ratcheted by 18 basis points. On a better than expected CPI print, we came down by 10. So the market is beginning to settle here. We're going to catch up with BlackRock in a little while. They say you want to stay at the short end of the curve because for tens at the bottom of your screen right now, will have the potential to retest that 5% level. But literally, it was unleash the hounds or unleash the bulls, whatever way you want to talk about it. Now we must debate the cadence of the cuts. It is not 2008. It is not 2019, which was 3. The yield gap closes, the potential yield gap closes between the Fed and the ECB, and that invigorates the euro and leaves the dollar offered. So what exactly are traders growing more confident of? Well, that the Fed will cut their interest rates this year as a result of that drop in the CPI. The Minneapolis Fed President Neil Kashkari spoke about what it might mean for the central bank.
How much downward pressure is monetary policy putting on the economy? That's an unknown. We don't know for sure. And that tells me we probably need to sit here for a while longer until we figure out where underlying inflation is headed before we jump to any conclusions.
So a often used refrain, we're going to have to sit here for a while, we need a little bit more confidence. Bilal Hafeez is the CEO of Macro Hive, joins me now. So Bilal, I looked through the body context of what he said. He's talking about the biggest uncertainty is the pressure on the economy. We can debate about the wealth gap and where that pressure comes to bear in a moment. But for a while longer, what does that mean? The market is saying September. Does that rhyme and chime for you? September live and a 25 basis point cut then?
I mean, my bias overall is actually not for a September cut. Instead, I think the risk is that we don't see any cuts this year. So I think yesterday's data, while it has pulled forward rate cuts, I think the market is overestimating the possibility of cuts. I do think that the U.S. economy remains strong overall. I do think there also is persistent inflation, especially in the services sector. So I think the market's getting a bit ahead of itself, and my bias at this stage, at least, is not to expect a cut in September.
And it's interesting. I started the show by saying, you know, bang for your better than expected buck in the bond market. In other words, we came down by 10 basis points. And yet when we got the hotter print, it ratcheted by 16, 17 basis points at one juncture. So there is this reaction function to incrementally better news relative to bearish news. Is the CPI as credible? UBS were with me yesterday saying owner's equivalent rent is nothing more than a fantasy. So really, how much credibility does CPI have in terms of the bleed through to PCE?
Well, there is a widening gap between CPI and then also PCE. But in general, I think what you have to do is you have to look at across a number of different inflation metrics to get a true sense. It is true that the OER measure is in the end some kind of weird moving average over 12 months. And in reality, if you look at other measures, the surveys of, say, consumer confidence and such, most people on the street are still feeling inflationary pressures are very, very strong. So overall, that tells us that there are still inflation problems across the economy at the moment.
So here's the debate, and Andrew Bailey encapsulated it beautifully for me, so much so that I'll use it 3 times. If it's good, overuse it, I say. It is not 1998. It is not 2001. It's not even 2019. So what is the cadence that we can expect here in terms of we are going into somewhat of an unknown, a fairly strong U.S. economy without an exogenous shock at the moment? And I emphasize the word at the moment because typically macro policy is only provoked or irritated into real movement by a dramatic exogenous shock. So what kind of cadence can you really look at if we're underestimating the solidity of the U.S. economy?
Yes, absolutely. I mean, I think it's hard to draw parallels to the recent past, so recent being the last 20 or 30 years, because we've been in this environment, at least since the mid-1980s, of declining inflation driven by globalization and all those sorts of factors. And since COVID, we've had a fundamental regime change, and everyone's trying to grapple around, is this a genuine regime change, or are we going to revert back to what we had before COVID? My sense is this is a regime change, so the cadence has changed. And there are important structural forces. One example is deglobalization, which is popularized by the clash between US and China, which is going to lead to higher inflation. And the other is, if you listen to central banks, frankly, they don't know what is causing inflation. They don't know how their monetary policy is affecting inflation as well. And that high level of uncertainty tells us that nobody really knows what's going to happen in the future, nor do they know how to calibrate policy in the right way. So all of that tells me that we're going to end up with an outcome that nobody likes.
Well, we have a bifurcation in where policy is restrictive, don't we? This plays to what Paul Donovan said yesterday, which is, lower class, blue-collar workers are having a tougher time in a 5% high inflation, grocery store, gasoline, living costs. They are materially biting. We're spending less at Walmart, at Starbucks, and those kind of companies were becoming more judicious. But the middle class, those people with savings and house and home equity, is indeed weathering this very well. And this is where the transmission mechanism of monetary policy is ultimately bifurcated.
That's correct. And that's been one of the key features of what we've seen over the last few years, because people have locked in low mortgage rates out to 30 years. So homeowners have not been affected by the increase in interest rates that the Fed has engaged in, whereas people at the lower income bracket, where they don't own their houses, instead they have to pay higher rents, they've been affected by high interest rates, which feed through to higher rents. So indeed, there is this bifurcation. And on top of that, in the US in particular, there's been a surge in immigration as well. So there's been this influx of additional workers into the US economy, which has pushed up rents and other such parts of the market. So there's all these new dynamics that we've seen over the past few years. And in the end, this does put more pressure on the income inequality dynamic that you're seeing in the US, but equally across the developed world.
It's interesting, but just looking at what Torsten Slok sent through from Apollo, of course, he's saying no rate cuts this year, but he talks about the very essence of wealth, which is about how U.S. homeowners, in terms of their expectations, their wealth, as it were. This is household expectations to house price appreciation. It's the highest since 2007. And this is the very essence of strength in the consumer in the United States, isn't it?
Yeah, and I would say there's two things related to that. One is that people's implied wealth has gone up a huge amount because house prices have gone up. And then the other side is, on the liability side, the value of their debt has gone down in some ways because they've borrowed at low interest rates, and interest rates have gone up elsewhere. And so in some ways, their borrowing has, from a wealth perspective, gone down. So from a net asset perspective, they've benefited both from the asset side and the liability side, which gives them a big benefit.
Bilal, great to have you with us on the reaction function. The bond market seems to have voted with its feet for the moment, but let's see whether that carries through. Bilal Hafeez of Macro Hive. Other stories trending on your Bloomberg terminal this Thursday morning. Cisco, as I said, she climbs in the pre-market after giving a solid sales guidance and profit forecast for the current quarter. The CEO, Chuck Robbins, is continuing his push to remake Cisco as a provider of networking services and software, a strategy that included a $28 billion acquisition of Splunk. Now, the shift still hasn't fully insulated the company from fluctuations in hardware purchases by corporate and telecom customers. Warren Buffett's Berkshire Hathaway unveiled a $6.7 billion stake in the insurer Chubb. The disclosure ends months of suspense over its mystery position in a financial firm. Chubb shares continue to gain a pre-market Separately, you had a quarterly filing showing that the Saudi Sovereign Wealth Fund had roughly halved its direct holdings in U.S. stocks. That was at the end of the first quarter, to a market value of around $18 billion. They'd replaced those with call options, so still maintaining exposure. We'll bring you the other highlights of the 13F filings a little bit later this hour with Sonali Basak. And Slovakia's Prime Minister Robert Fico has suffered life-threatening injuries after being shot in public. It's the first assassination attempt on a European leader in more than 2 decades. The 59-year-old was in hospital in a very serious condition following the attack by a gunman, who police say had a clear political motivation. Fico returned to power last year as a force of opposition to EU institutions in Brussels. The US says it's accelerating arms supplies to Ukraine as the country's military confronts the Russian assault in the northeast. Russian troops are pushing deeper into Kharkiv region, taking control of some villages close to the border. The offensive stretch in Ukraine's forces may push Kyiv to redeploy its units to the front line in the east. Well, coming up, the Russian leader, Vladimir Putin, visits China, drumming up further support for the war in Ukraine. We'll have more on Putin's meeting with Xi. That's next. And later today, don't miss our interview with the JP Morgan CEO, Jamie Dimon, 8:15 a.m. Eastern Time. Context matters on Bloomberg. It's Bloomberg Brief. I'm Manus Cranny in New York. The Russian President Vladimir Putin met the Chinese leader Xi Jinping in Beijing for the first time in his new term. The meeting comes as Russian forces press forward with a new offensive in Ukraine.
China and Russia agreed that a political solution to the Ukraine crisis is the right direction. China's stance on this is consistent and clear.
For more on that meeting, let's bring in Bobby Ghosh. He's at the Qatar Economic Forum. The region that you're sitting in has very close relationships with China, Bobby. This is Putin's first trip in his new term, and I like how Bloomberg has phrased it. It's creating this crusher relationship. Your take on the meeting and how they extolled one another's commitment to one another?
Well, in a previous meeting, they talked about a no-limits friendship between the two countries. This time, they took it one step farther and said this was a friendship that would last for generations. This would be music to Putin's ears. He's there as the supplicant, as the junior partner in this relationship, and he's looking for reassurance from Xi Jinping that Beijing's support for Moscow remains firm. And at least in terms of rhetoric, he got that. Trade relations between the two countries, very strong. It has softened recently because Chinese companies are getting nervous about American threats of retaliation for those who trade with Russia. So Putin was looking for ways to overcome that. There's some talk of new banking deals. We haven't heard the details, but some talk of new banking deals that would make that trade easier, that would insulate that trade from international sanctions. But as I say, we haven't yet seen the proof of the pudding. This is mostly about optics. This is mostly about Xi Jinping telling Putin, you're still my guy. And that's exactly what Putin needs to hear.
What does that mean for the world that you're sitting in today, which is the world is trying to find off-ramps on the Gaza Israel conflict, and also in terms of the position of China's influence on Putin in Ukraine? Is that theater or real? Or how does the world view Xi's role as a conduit to Putin?
Well, as you say, I'm in the heart of the Middle East here. And a lot of attention is focused on Gaza, on that particular conflict. But this is an economic forum, so a lot of people are also talking about the Cold War between the United States and China and how they are caught in the middle. Just like Russia, they too have to negotiate this Cold War. They too need to figure out how they do deals with companies in China, how do they do business with China, what happens if those businesses come under US sanctions for activities elsewhere in the world. Russia, for instance. These are very treacherous waters for companies everywhere to have to navigate. And folks here have expressed that concern to me over and over again.
Okay, Bobby, well done. Great work by you and the team at the Qatar Economic Forum this year. Some great content. Bobby Ghosh reporting from Doha. We've been talking about the 13F filings. This is just a small representation for you. Michael Burry of Scion, of course, upping his bets on some of the China names on JD and Alibaba. JD.com, it actually overtakes Alibaba as their top holding. They boosted their JD position by 80%. We'll talk to Shanali more about that. That's really doubling down. And Nvidia is there because the hedge funds, well, here's the shocking headline. The hedge funds up their gear on Nvidia. And they cut to AMD. We'll talk more about what's driving some of those movements with Shanali a little bit later on. Now, the meme stock rally, it's just fizzling out, isn't it? AMC, both down by double digits, along with GameStop. We'll talk to you about meme stocks in just a moment. It's Bloomberg Brief. I'm Manus Cranny in New York. What's making the front pages around the world? Let me just tell you. First up, we've got the Wall Street Journal focusing in on Microsoft. We understand 700 to 800 of their China-based cloud computing staff and AI employees, they were offered or asked to consider relocation. They could move to the US, Ireland, Australia, and New Zealand. And you've got this tension between Washington and Beijing mounting, certainly on the technology front. That certainly was apparent, as we just discussed there with Bobby Ghosh, in terms of the Cold War. Well, the US Bureau of Labor Statistics, they published the CPI 30 minutes early. Did you see it? Did you find it? Full investigation is underway. No obvious signs of the early publication actually moved markets. IBME, let me know. Did you have the leg up? And the LA Times talks about Tesla and the context. More than 601 jobs in San Francisco and the Bay Area have gone. This is going to be the 5th week of layoffs at Tesla. And Musk had announced in early April that the company was laying off 10% of its global workforce. So let's focus in on the markets. We've covered it all week. The meme stock frenzy. GameStop and AMC double-digit drops pre-market this morning. Is the meme stock rally fizzling? Well, the Marathon Asset Management CEO Bruce Richards says he's been chasing in. Take a listen.
What's the big lean in? You know, you got to look at Keith Gill and you got to look at the Roaring Kitty. We've been leaning into, say, AMC. So we're long AMC for like a year, 2 years, 3 years. And when you lean in and AMC goes running up, there's a lot of equity that the company can now raise, and that goes right into our pocket because we're earning 15%. Senior secured, leaned up against all their assets.
And they already did that.
We're debt with debt protection, and we're earning 15%, thanks to Roaring Kitty and all the meme fan club that's buying up AMC.
So the debt issuance that we had announced yesterday by AMC, you think we're going to see more of that from some of these other stocks? Oh,
absolutely. When you raise equity, you raise that, and it's a combo platter trade. And we're long, kind of the senior secured stuff that we bought in the 60s, that went to 70s, 80s. They're now in the 90s, but we love them still in the 90s because we're earning 15% yield on that at a discount with all that equity cap that backs it now, and in a senior secured position.
Everybody's a winner, at least until the moment it turns. Marathon's Bruce Richard there. Speaking to Bloomberg, well, Charlie Wells is with me now. I mean, you're looking at, what is it, $11 billion, Charlie was just looking at the number in the story. $11 billion in equity value for both these stocks. It's turned around. What's causing the exhaustion?
I mean, look, man, is this is it? I think that's the question that a lot of people have. I think, early this week, there had been this expectation that maybe this meme rally would continue. But look, there's much more sophisticated actors now getting into meme stocks than were in, of course, 2021. We just heard an interview with someone who's a much more sophisticated investor. And in a lot of ways, this is kind of a momentum play. I've been talking with a lot of professional traders this week about meme stocks. And what they told me was that they saw options activity picking up last week. And then, of course, we had that tweet from Roaring Kitty, which just sent prices into overdrive. But with more sophistication comes also a better sense of when to get out. And it's looking like people are doing that now.
Well, sophistication or fear? Fear by Wall Street, actually, that the game is up and actually that the retail can roll back and bite them on the proverbial. So is it over? I mean, is this a short, sharp burst of roaring kitty roaring back to life and docility is the future?
I think what you said there is, kind of a meow this week. And, short and sharp, I think, is the way to think about this. I mean, structurally, we are just in a much different environment than we were in 2021. I mean, look at interest rates, right? I mean, that's one of the huge differentials there. But I think something that's important, though, is social media investing is here to stay. And so if this rally does not continue, that's that. But we're likely to see these sorts of bursts, these meows in the future.
Ah, good man. You got a nice little pun in there. I hadn't thought about that, Charlie. Wow. Okay, Charlie Wells on the meme stock and getting his own little pun in. Quick snapshot of bonds. It's the market that counts. This is the global bond market. Of course, pretty significant moves yesterday in 10-year government bond yields, both at the short and the long end. My next guest, of course, from BlackRock says you want to probably be at the shorter end of the curve because 10-year government bond yields could indeed retest 5%. What could irk it to be there? We'll ask that question on Bloomberg. From our global headquarters in New York, I'm Analyst. Let's set your agenda. Risk on unleashed as cooler U.S. inflation reinforces Fed rate cuts as soon as September. Big money bets. Buffett's Berkshire reveals a stake in the insurer Chubb. Michael Burry doubles down on China tech. And we get a fresh read on the consumer and the global economy. Walmart and Deere report results before the bell. A very good morning. So for a better than expected CPI print, you were rewarded. You were rewarded with a risk on momentum from bonds to equities. The bond market at the short and the long end moved by 9-10 basis points. The last time, however, you got an unfavorable CPI print, this bond market moved by 18 basis points. Whatever way you look at it, we now must debate whether the 3-month hump in CPI has passed and is the roadmap clear to cuts. How clear is that, and what cadence will those cuts be? Records in the equity market were abound. You had BMO upping the game to 5,600 from their target just a couple of months ago, 5,100. And at the bottom of your screen, you can see Chubb up 9.66%. Buffett's Berkshire reveals their holding there. They'd been given permission to not reveal that for quite a while. And Michael Burry ups the game on JD and Alibaba. More on that with Shanali in a moment. Cisco also bid up this morning ahead of the market. They're raising the full year guidance. And I suppose it's a bit of a relief in the euro that the gap between the US and the ECB may be narrower, and that gave the euro a little bit of a bid yesterday. We're down 1/8 of 1% this morning. So the Treasury rally after the CPI report. 10 years fell as much as 10 basis points, as I said to you. And bond volatility, this is the key for fund managers. They've got to overhaul their trading strategies, with bond mutual funds flipping treasuries at a ratio of 49% higher relative to 2022, making buy and hold investors turn into traders. Vasiliki Pachatouridi joins me now, head of EMEA iShares fixed income strategy at BlackRock. Good to see you this morning. I'm curious to know, I mean, the mutual funds flipping into traders, but if you were a buy and hold, if you held treasuries from the start of the year, you lost 2%. The quant funds made 5%. Do we need to be more nimble? Are you being more nimble? Are you being more dexterous and perhaps being pushed into more of a, not flip mode, but a more active engagement mode in the bond market? Good morning.
Good morning, Manus. Thank you for having me on the show. That is a great question, but let's start thinking about the investor. And I think it's good news for the investor. I would say people should just embrace the pause right now. Investors should continue clipping in that yield from quality bonds. But to your point, they should be actively looking for opportunities in select parts of the income market. And I think the beauty with where yields are right now, you can rely on bonds for income, but you can rely on bonds for adding alpha and performance in your portfolios right now. And history is on our side. Bonds tend to do well when the Fed is on pause.
Yes, and they are on pause, and now the market has decided to wake itself up and say, look, September could be potentially live. And I just want to get a sense from you. We debated that there was this hump or bump in CPI in the road and that it was going to be tough. Now the market has pulled forward and looked at 2 rate cuts. That that is very much consensus for you. But you want to be positioned more at the short end of the curve rather than at the long. Why?
That is correct. So we think that, the markets got yesterday some good news, but we're still looking at inflation being above the target of the Fed. We still expect to see volatility ahead of us, and we don't think the Fed is going to cut rates before the end of the summer. And we also have other reasons to believe that the long end of the curve is still susceptible to volatility, more structural reasons, the fiscal part of the story, structural reasons that are driving inflation upwards in the long term. And that is the reason why we're more cautious on the U.S. duration, so staying closer to the front end and the belly of the curve. But I also think the divergence of monetary policies and yield differentials that we see right now create opportunities to position differently in other parts of the world. And we're more comfortable, for example, owning duration in Europe and certainly in the UK. So again, going back to your beginning statement, yes, it does pay off to be more active in fixed income right now. And there's certainly tools out there to do that so.
And that's interesting, is that you're more bullish on gilts and bunds, perhaps, than you are on treasuries. So are you active in those kind of spreads? Is that how, do you play it outright picking up UK and European duration, or do you look for the differential and the spread?
Yeah, I think right now it's about kind of that difference in the monetary policy. We have more clarity where the ECB is going and where the BOE is going versus in the US. And what we're seeing from investors and ETF flows, for example, is that, when you look at European fixed income markets, it's about real yields. And real yields in Europe, in the UK, have turned positive since the end of 2022, and that real yield differential between US assets and European assets has really narrowed down, even though the nominal yields are still quite different. And I think that is why we see investors, definitely when they use ETFs, staying closer to home. We see a lot of demand for euro-denominated fixed income ETFs. And as I said, just having that more nimble approach to building portfolios.
And this compounds, I mean, I want to extrapolate this into credit, because I know that you've downgraded your credit strategy, and that's more of a US downgrade. I am dying to know why you've done that. I want to know whether it's cracks in the consumer, the spreads have compressed too much, or is it that you are concerned about some kind of a slowdown and a refunding wall here relative to high yield and IG in Europe?
Yeah, that's a very good point. I mean, listen, investors are definitely recalibrating portfolios right now. Investors are still underweight fixed income. So we have to consider the two lenses of how you build a portfolio, and that is on a strategic basis and on a tactical basis. On a strategic basis is where we downgraded investment grade to an underweight, and that is purely based on the spreads having tightened so much, but also looking at a little bit long-term, potentially the higher cost of capital and the refinancing that we see in the future, potentially causing spreads to widen further. But this is not a story for 2024. And that's where, again, putting on our tactical hat and where can you make money this year, tactical opportunities do exist. We have a preference for European credit, both IG and high yield. When I look at Euro IG right now with yields above 3%, you're getting more yield from bonds than you get from European stocks. And when you look at Euro high yield, for example, again, that's where the dynamic in duration, it's relatively a short duration market. You get the yield pickup, the issuance that we've seen, which has been incredible this year, has been so well absorbed, and investors seem to continue to love credit. We had more than 30 billion going into credit ETFs in 2024 already.
No, listen, I hear you, and I understand the underweight perspective for the sovereign relative to the credit. One thing I do want to get a perspective on is how much you and the House are talking about debt. Because we caught up with the Goldman president and CEO, John Waldron. He spoke to Bloomberg, and he said that the US government should not be lulled into thinking there's an insatiable appetite for debt ever ending.
Those of us that have been watching this for a long time are worried that this is an unsustainable pace and that we need to show more discipline in the system. And, I think the US continues to be a great place to invest.
So that's John Waldron. I mean, we've had warnings as well, Vasiliki, from Ray Dalio in the FT overnight, from a number of other heads at the Qatar Economic Forum this week, talking about the risk, the real risk of a choke point in the U.S. Treasury market. Is that a real material risk that you talk about? And I presume it's a 2025 risk rather than right now, right here.
Exactly. So it's not a risk for this year. It's a risk in 2025. But I think that comes back to our earlier points around volatility in data, volatility in macro. And I think that's where we see investors trying to, manage risk in their fixed income portfolios, whether that's coming from rates, whether that's coming from the inflation data, from the fiscal point. And to me, that's why I see, for example, trading volumes in fixed income ETFs surging in times like this, because people want to be more active in their fixed income portfolios.
Well, hopefully we haven't missed the boat with that sterling trade on the gilts. Vasiliki, great to have you with us. Great clarity around the calls from credit to sovereigns. Vasiliki Pachatouridi, my guest this morning from BlackRock. Context matters. It is Bloomberg Brief. I'm Analyst in New York. So the Wall Street fund managers have shown us what's in their 13F filings, and many of them shifting into the tech sector, no shock there, propelling the market. But one of the big discoveries was for Berkshire Hathaway, $6.7 billion stake in Chubb, the insurer. Now, it's no shock that it's an insurer, but they were given a bit of a reprieve on this. Sonali Basak joins me now. So it was a final curtain reveal. We know Warren Buffett loves insurance. Where does Chubb fit into the family? What's the size of the holding? Just put a bit of context around it for me. Good morning.
It's a very large holding here, and good morning, Manas. It's a talk of the town, really, when you think about the insurance industry, because Berkshire, of course, has its own massive insurance operation, Geico being a part of it. So you would think on the face of it, why would they be taking a nearly $7 billion, a $6.7 billion stake in Chubb? And when you think about it under the surface, really, Berkshire is also a reinsurance company. When you think about the insurance industry, there's a lot of frenemy behavior going on here. It does spark a massive question under the surface on what the motive is here. Does Berkshire want to play a role in a broader industry consolidation? Chubb, remember, is run by Evan Greenberg, the son of Hank Greenberg, who built AIG. They built Chubb into a massive insurer through the purchase of ACE. And so can they do more? Remember, this is an industry that is facing a ton of cost pressure, and scale could really help the industry out.
I just wonder at what stage regulators look at the holdings, Geico, National Indemnity, Aon, Chubb, and they say, you've got quite a grip on pricing in this market, or is that even being floated as a kite at the moment?
Yeah, that is certainly a question. This is an industry that's consolidated significantly, and Berkshire plays one of the largest roles. We have seen regulators take a look at before, but this is also an industry that is regulated state by state very significantly in the United States. We have not seen a whole lot by means of putting the clamp down
regulation
on that type of consolidation, but this is another era if we did see a type of merger play start to happen here in this administration. Of course, it's been tough on antitrust.
Now, of course, what Michael Burry does, the whole world sort of looks at through the lens, I suppose, of the movie. But he's a very credible fund manager, a very credible manager, and he's doubling down on China.
He sure is. And remember, he had exited a lot of these positions just last year. So this reversal is also interesting. And we think about motive. Remember, these are positions held at the end of March. And so when we look at 13Fs, there is a lag time. But he did get back into the likes of JD.com and Alibaba. And we've seen diverging performance this year in a lot of those large Chinese tech names. Now, when we talk to a lot of fund managers, they do say they see a tactical opportunity in Chinese stocks. But we do see differing opinions here when it comes to these Chinese holdings. We see Coatue, for example, increasing, JD.com and Baidu as well, but Tiger Global selling some of their JD.com. So is there a lot of trading versus long-term holding in these kinds of positions?
Now, Peng Zhao was here in the building last week at the Sell-Side Forum. I caught up with, I just literally said hello to him and Eric Schatzko before they went on stage. He was pretty bullish about the business that they're doing. and it has quite literally rained money over there.
There are the hedge funds, and then there are the market makers. To your point here, Citadel Securities has been minting money in the empire of Ken Griffin here. Citadel Securities being the market maker, $2.3 billion of net trading revenue in the first 3 months of 2024. That is setting them up to potentially have a record year. They have been adding products. They have been hiring talent from all across Wall Street. This is very noticeable because
up 68%.
Stunning.
Year over year.
Stunning
I'd love
rise.
to be in the bonus negotiations for the different desks around there, because I think that would be tempting. But I mean, this just shows you we've got monster rally in markets, and so that naturally drives up the commission rates on these deals as well.
It sure does. There's a lot of volatility in markets to profit off of. Remember, there's also bank regulation hearings this week as well. And as they tighten the screws on the large banks, you wonder how much these market makers can grow even more.
Shonali, thank you very much. Setting the agenda on 13Fs and Citadel. Well, two bellwether companies will report their earnings today before the bell. You're going to find out what Walmart made, an insight into the consumer, and then you've got Deere's results, just exactly how the global economy is performing. Dasha Afanasya joins me now, covering Walmart this morning, and Christopher Chilino from Bloomberg Intelligence, Chilino, joins me now. So, where should we start? A little bit of Walmart, because you've got that battle between Amazon and Walmart kicking off. Dasha, good morning.
Good morning. Yeah, I think with Walmart, you can look at the economy and the state of the economy, which is pretty strong in the US. So on the one hand, you know, you've got GDP not growing that quickly and disappointing last time, and unemployment increasing, but it's only at 3.9%. And I think for consumer companies, the real issue is what the Nestle chief executive, Mark Schneider, referred to as the bifurcation of consumers, which is where the people who are really kind of hard up, the lower income consumers, are having a really tough time. You know, there's been a reduction in food stamp payments, they're budgeting week to week, and it's those kinds of consumers that Walmart might see spending less, even as the economy overall looks quite strong.
And then I suppose we've got to keep an eye out on the management's response to some of the uneven economic times and that competition from Amazon. I know Amazon is a wholly different company, but they are still there on the retail side as well, aren't they?
Absolutely. I mean, right now, Walmart is the world's biggest retailer, but the pace that Amazon is growing, it is catching up. So the company has taken steps to get costs under control, keep growing its e-commerce business. So it's actually reducing the number of corporate jobs that it has, and ushering its remote workers into fewer hubs to save on costs. That's on the operational kind of cost side. But then on the promotional and marketing side, promotions are a big thing in the US right now, and consumer companies are faced with this dilemma. Do you use promotions to protect your market share, or do you protect your brand value by, you know, staying off the promotions and hope that eventually, you know, your brand will win? And finally, kind of in a hint of an appreciation of the splitting off of the consumer in the US, Walmart is actually targeting the more premium, the more middle-class consumers. It's been renovating its stores to try and compete with companies like Taggart for these sort of more treat products. So you have, you know, duck breasts, blazers, cargos in these renovated centers with kind of better lighting, mannequins, and that obviously takes investment. So the bet is that whilst appealing to the lower income consumers with lower prices for very necessary items, they'll also appeal to the more resilient part of the segment.
Yep, it's really just trying to get the blend right in store. Dasha, thank you very much. Dasha Afanasieva on the outlook ahead. We're going to get those Walmart numbers shortly. Turning to Deere, it's the bellwether, if you want to think of it in that way, for the global economy. Christopher Chilino, industrials analyst over at Bloomberg Intelligence, joins us now. So what can we expect for Deere's second quarter results? How exposed are they on a global basis, let's say to China and to other parts of the world that we have been consistently worried about?
Yeah, well, Deere certainly faces cyclical headwinds and a pretty challenging setup in 2Q as global ag markets continue to soften, just given the weaker farm economy. I'd say less exposure to China directly. It tends to be more indirect, as they're obviously the largest buyer of our crops. But Not to mention, we still have this high interest rate environment. There's been the age of the fleet has come down pretty precipitously over the last 3 years because we've had some real strong buying. So from a demand perspective, we really continue to see incremental weakness in the quarter, which we think is likely going to necessitate some additional production cuts, as we already have too much inventory in the channel. So we'd expect Deere to really underproduce retail demand globally over the balance of the year. You combine that with some mixed headwinds. They also have a tough comparison. 2Q is really going to be a difficult quarter with both double-digit top line and earnings compression. And we actually saw both their peers, CNH and AGCO, cut their 2024 guidance this quarter. So I suspect that we'll see Deere trim their outlook as well.
And tell me this, where are we in the agricultural cycle? We had Jeff Curry with us talking about the commodity cycle. You know, copper is the new oil, but obviously those are on the hards, and there's a different story there. On the agricultural side, the question, I suppose, for you and the team is, are we somewhere near a bottom?
I think it's probably too premature to call a bottom in the ag cycle. I mean, we're just coming off a peak last year. A lot of the ag indicators that we watched, I'd call maybe mixed at best. Farm fundamentals continued to deteriorate. And we're looking at probably another bumper crop this year, which is really going to keep downward pressure on crop prices. So, and we also have this uncertainty about the duration of this inventory destock. So historically, you know, downturns in the ag cycle don't last 1 year. I don't think this year will be any different. So we actually see more downside risk to the ag cycle and estimates in 2025.
Okay, Christopher, thank you very much. That is Christopher Chilino on Bloomberg Intelligence. We'll see what those numbers are in a little while. Coming up on the show, we're going to get you set up for your trading day. From the results to the macro, right here on Bloomberg.